Welcome to the next part of the business segment of our presentation. For our business, as with any business, to be viable, we have to find that sweet point between the price we make money at and the price that our customer will accept. A substantial amount of analysis went into that, and we are going to go through that in this next segment. Starting with the market trends and growth, we have over here on the right this the largest bar depicts the growth of the satellites in geostationary orbit over the next 21 years, projected from several sources, which we'll include at the end of this slide presentation. To make it easier, we took the total number projected over the next 10 years, divided it by 10 years, and came up with a linear growth and applied that here. The portion of that market, about 3/4 of the market currently is hydrazine. And that portion of the market is depicted here in the yellow bars. And then the 1/4 left, or 22.2% remaining, that is xenon, is this green market here. Over here on the left, you can see this trend as xenon is increasing slowly, as hydrazine is decreasing as percentage of the market. And here is our linearization, which came out to about 150 new satellites per year. We used a 1% initial market penetration and then a 0.5% continuing market penetration, which we distributed evenly between the two markets of hydrazine and xenon. Here you can see our client growth, and that's the total number of clients that we have over time, whether we're servicing them or not at that particular point. I guess you could say those are the ones that are paying us and that we have contracts with. This is the number of refuels per year that we are achieving. The orange one is the total number. The gray line are the number of xenon refuels, and then this yellow line is the number of, the yellow line is the number of xenon refuels, the gray line is the number of hydrazine refuels. And that's the per year rate of refuels or docks with a client satellite. In our cost analysis, we took into account the launch costs, the initial development costs, production of the first run, which we went into the cost to qualify, and then each of these are launches, launch 1, 2, and 3. Here, each one has 3 transporters on it, and each of these have 1 depot. So for our analysis, we did 1 launch of transporters, so that's 3 transporters, which we estimate for a 21-year lifespan. Down here we have the depots, and we went through 3 depots in that 21 years. They last about 7 years as our design estimate. So we'll see 3 of these and 1 launch of these. Over here we have our ground infrastructure costs and our salaries for aerospace engineers. You'll see here that we started with some numbers from the 2010 fiscal year, and we used this inflation factor to convert it to 2020 dollars. For the costs and discount rates, we have the first launch of the depot, our first launch for mission. That includes the 3 transporters and 1 depot. And then these additional launches are not including the development costs, which are included here. That development cost, or that first launch cost, is what it costs us to get to our first client. And that is where we go with our development costs, or what the investor would be asked to supply. Our annual expense total here. And this is our buildup of our discount rate, starting with the median 20-year bond interest rate, which currently is extremely low. And industry factors, business age factors, and so on and so forth that all add up to the versus discount rate, which is what an investor would be looking to get as their rate of return. That's going to bring us to, this brings us to revenue, cash flow, and accrual. Our first graph here on the left is our total revenue. That's before any of our costs are in. That's simply what we charge the client and how much that grows over time for 21 years. This second graph is our annual accrual. This takes into account all of our depreciation and our costs, annual costs, etc. You'll notice that this shows us that period where we are losing money at the beginning, and then we actually start to make money at this point in time. This graph on the right, this is our cash accounting. Now this is profits, but this is the EBITDA. This is earnings before depreciation, tax, interest, and amortization. We'll use this column later to determine the valuation of the company. It's also used to determine the payback period, which you can see this little box over to the left. This is the payback time, and this is the years. So this is our development period of 7 years, and then our post-development revenue period. So this is after we start servicing our first client, and we have 11 years until we reach a high enough revenue stream that we've paid back the investor's investment. And that gives the investor a total payback period of 18 years. Profit and payback period, as we just discussed, as you can see right here, well, this would be 11 years. That's down a little bit. This would be right here at 11 years. And the sum of all of this is just a little bit higher than our investor's initial investment. This is the investment required of $1.5 billion. And in our cash column, we achieve that by year 11. We also have our total cash accounting, which is the sum of this column and all that we make over the 21 years of $8.8 billion. And our total accrual, which is the sum of this column, which is $6.9 billion over 21 years. This is our return on investment for our investor, and you can see it here over 21 years for both the cash accounting and accrual accounting columns. Again, you have the cash and accrual columns to give us our annual rate of return. This is actually the annual rate of return that is used. This was just a reference. And you can see, as you might recall from an earlier slide, that the rate of return that the investor would be looking for was about 28%, and we are sitting right at about 28%. In year 5, we take the amount that we made. Oops. Sorry about that. We take the amount that we made in year 5, and we multiply that by a nominal 8 times EBITDA to get our valuation in year 5, which is $155 million. If we were to do that in year 6, I'm sorry. If we were to do that in year 21, that number would be $8 billion. Again, we are doing our analysis with the average revenue stream of a satellite being $140.4 million and charging 4% of that revenue stream per year as our service fee.